Guys, what on earth is this weather? Honestly, it's supposed to be 38 degrees here in London. That's unheard of. I literally don't want to do anything apart from sit on the sofa. I guess we should probably think about getting aircon installed since global warming is a real threat and, you know, the summers are just getting really hot now.
Guys, thank you so much for joining me today. Today I want to go back and talk about dividend investing and also back to that investment agenda, how to build that passive income. Building a dividend portfolio and using DRIP to compound returns has been a familiar topic for anyone talking about personal finance and fire seekers. It has a ton of benefits, which include low access point. We can start catching the investing bug early with the nominal sums of money that you can invest. Dividend seekers look for stable income generating companies, which means we look for strength in balance sheets. I did do a previous video on how to seek out robust dividend stocks with the rules that I use personally to pick my dividend stocks, and I'll put a link down in the description box, so go check it out. Just out of interest, I ran through my checklist today with my rules that I mentioned in that video, and in the present time, right now in the UK, out of the entire stock universe, there are only 8 stocks that I would consider investing in that meet my checklist criteria. But that's the whole point. Dividend stocks have particular characteristics that we should be seeking out. And unless you have a set of rules, you will be swayed with the tide. I really enjoyed recording my Be Cheerful video last week with all the doom and gloom in the market and the realities of a second peak. I do think it is quite important to remind ourselves that we as humans are a resilient bunch and we will work our way through it. I think our economies will evolve, the businesses that support it will evolve too, which is actually true with each recession. And so as investors, we need to stay grounded over the long term and really avoid getting swept into panics and trends. It's really difficult to say all of this in the week where BP, a stalwart of the FTSE 100 and a national giant and a beacon of strength at the start of the year, now hits its Altman Z score. And remember guys, if you watched my video on me picking my dividend stocks, that the Altman Z score is a score that was devised to test how close a company is to bankruptcy by looking at specific financial ratios. And it's about 72% accurate in predicting bankruptcy 2 years before the event. So it's no wonder really that the stock itself is down by 32% year to date. And it also announced an $18 billion loss for the last quarter and slashed its dividend in half. Can you imagine the shock? So to my earlier point, the business model is evolving and BP will no longer be an international oil company, but now is going to be known as an integrated energy company because they're focusing not just on oil and boosting investment in low carbon by 10 times by the time we get to 2030. As Schumpeter said, innovate or die. So the company has to evolve or it will die. The other very cool thing about all of this, and something I think is super important, is moving from a progressive dividend policy to that which the dividend is paid from cash generated from the business. And that's a pretty brilliant thing if you think about it. I don't think a company has to have the mantra of paying more dividend no matter what. Corona has just shown us that. For example, that there is risk in progressive dividend policies. A company may take debt to pay its shareholders, but I don't see why that is ever a good idea. In my checklist, I generally exclude companies with high gearing and low dividend cover and low current ratios. And these are all indicators of balanced strength. Investing is not punting. Anyone that's been to Cambridge will know punting is a lot of fun actually. Although I do feel a little bit weird. When we went to Cambridge, my husband and I were just sat there and the guy, the punter I suppose, is punting away. And I felt like I had to get involved because it was a little bit weird, him just standing above us, behind us and all of that jazz. But anyway, that's a story for another day. But we have to think about it this way. Corona has battered the demand for oil, but it has also sped up the shift to renewables, which was happening anyway. I'm not going to go into the general pros and cons of investing in BP. It's just a great example of stories dominating dividend investing at the moment. So I felt like I had to mention it. The question is, should you get rid of your dividends? Don't go crazy, people. Some of the chats I have been having on YouTube have been balancing dividend versus capital gains. Now with the collapse of a lot of dividend stocks, hindsight is a beautiful thing, and that generally investing for income is naive and foolish. Investing for income could mean we overlook companies that provide capital gains through building and scaling their businesses, and we can then sell off some of the proceeds on an annual basis for income. Yes, that does kind of make sense, particularly if you're fully retired. It does make sense to have an approach to your portfolio that includes extracting income from your portfolio through realizing those capital gains. And most retirees will not have a portfolio large enough to generate a dividend income that will cover their expenses anyway. It's just one of those facts that we are and should be aware of in this community, and why we spend so much time reading and researching on building income streams and following all of those FIRE philosophies anyway. So yep, for those needing an income from their portfolio that do not have requisite dividend yields from the portfolio, you would need to think about a mix of capital gains and dividend income. However, to suggest the ludicrous notion that dividend investing is dead, stupid, or naive has left me a tad bit annoyed. Firstly, the fundamental value of a stock depends on the cash that an asset will generate. Now, we all know that the stock market is a function of both intrinsic value, which is the stock price based on the fair value of the company as it is now, and then using a technique called discounted cash flow, and that works out the present value of future cash. Now, there are an army of investment professionals that just do this itself. That's all they do. It's called value investing, where investors find stocks where their intrinsic value is higher than the stock market price, which suggests that the company is undervalued. Do you see what I'm saying? This all does sound a little bit technical, so I will try to keep it simple. There's a stock valuation method, and that's called the Gordon growth method. It basically theorizes that the stock price is a function of its current value and all its future dividends discounted back to the present. It's very interesting and quite a technical model, and there are quite a few YouTube videos on it if you are interested in that kind of jazz. But in short, we can't really expect the share price to continue to rise if a company can't deliver healthy growth in the dividends. The second thing I wanted to mention is that coronavirus has favored capital growth stocks. It sounds a little bit like horses for courses, even though the crisis has favored capital gain type strategies, with stocks rebounding quite quickly while dividends and earnings have actually collapsed. This isn't normal, and prior to the crisis, it's shown that dividends fall much less than share prices. So if we were taking a capital gain strategy in this particular circumstance, in a prior crisis, we would have been screwed. I know this is an odd point to make, but it does bring me onto a third point, which is all strategies need planning and commitment to the plan. Dividend investing should totally include building dividend reserves and a buffer, either by having more income than you need or forming part of your multiple income streams. And I also think likewise capital gains investors need to sell or trim sustainably, but it is way harder to do because the motivation is a little bit more greed oriented in my opinion. I do think the unpeculiar quirks of the whole crisis, it shouldn't mean we need to abandon or stop investing in dividends. Dividend investing is simple, safe, reliable. If you have built a robust checklist, invest consistently, it will continue to bear fruit like the generations of investors that used it in the past. And if we are sensible, we can avoid the dividend traps designed to entice us into stocks that really cannot sustain payments through thick and thin. So that's a wrap, guys, for this video. Do let me know in the comments below what your thoughts are. Drop me a like for the algo and subscribe if you haven't already. But until next time, cheers guys, I'm out, bye.